Okay. So problems didn't go too bad. How
No.
many of you went back and looked at the quiz? Did it
I
help?
did. Yeah, some.
No? Did you do better on it after?
Yeah, I did.
Okay. Well, good, good. All right. So what we'll do? Let's just go ahead and jump into some of these problems and see what's going on there. We'll wrap them up. I forget how many I told you guys to do.
There's like 11.
11.
Yeah. 1 through 9, 12, and 15.
Okay. We'll go through those. Then we'll review for the exam and talk about the exam a little bit, okay? All right, so let's look at the first one. So we got a, there we go. All right, so we got Jackson Timberlake just paid a dividend of $2.15 per share on its stock. So which D is that?
D0.
D0. So D0, okay, 215. All right. The dividends are expected to grow at a constant rate of 4%. So we have G. Okay. Investors want a rate of return of 10.5%. Okay. And let's see, they want to know what is the current price. So we know current price equals D1 over R minus G, right? But we have D0 instead of D1. So we know we got D0 times 1 plus G. Okay. So now we just got to plug that in. So we have the 215 times 1.04 over minus 0.04, right? Okay, and what do we get for the current price there?
$34.40.
There you go, $34.40, okay? Now, it asks you for, what's the price in 3 years and what's the price in 15 years, right? So remember, we could get the price in 3 years, but we would need D4, okay? That's one way to do it. And in this case, since we have D0, okay, we'd have to calculate the D4. Again, just me, if I already have the current price, I wouldn't mess with doing it that way. I would use what I have for time value of money. Okay, I know the current price is $34.40. That's a bad 4, I'm sorry. Right? It's going to grow at 4%, and I would calculate it out 3 years from now. Okay, so what's the price 3 years from now?
$38.70.
Yes. Okay. And I'll try to remember to write the answers in red from now on. And then if we take it out 15 years, what do you have for over 15 years?
$61.95.
Yep. Okay. Is everybody good with that, or any questions there? Okay. All right. Everybody seems to be good. So let's move on. So let's look at number 2 then. Okay. The next dividend paid for this company, Zavitz or whatever, will be $2.34 a share. So the $2.34, which D is that? Is that D1 or D0?
D1.
D1. Very good. Okay, so we have D1. they're going to maintain a growth rate of 4.5%. Okay. And the stock is currently selling for $37. Okay. So here we're looking for R. And we know R is D1 over PO. What do we call that? D1 over PO. Do you guys remember?
The dividend yield.
Yes, that's the dividend yield. Thank you, Carolyn. Or was that Madison? One of you. Okay. And then our growth rate is G. And what did we call G?
Oh, that's your
Capital gain yield.
There you go. Capital gains yield. Good job. Okay. All right. So now you don't have to calculate D1 here. You just got to plug and play. So we have 234 over 37 plus 0.045. Okay. So what do we get for our rate of return here?
10.82%.
There you go. Okay. Is everybody good? So if that's the case, number 3 refers back to this, or is referring to this same problem. So I'm just going to put 3 right here. 3 says with the previous problem, okay, what is the expected capital gains yield? Well, we said G is our capital gains yield. So we know that that is 4.5%, right? And then it says, what's our dividend yield? Ooh, sorry. So that would be the 10.82 minus 4.5. So what's that? 6.32%. Okay. Is everybody good there? Sorry, that's purple. I don't know where that came from. Guess I'm feeling colorful today. All right, questions? Good. Okay, let's look at what did I do? 4? Let's look at 4. Hudson will pay a dividend of $3.28 per share next year. Which D?
D1.
D1.
D1, 328. Very good. Okay. The company pledges to increase dividends by 3.75%. Okay. Indefinitely, if you require a 10% return on your investment, how much will you pay for the company's stock? So PO equals D1 over R minus G. So we got 328 over 10 minus 0.0375. So what do we get for our price of this stock?
52.48.
Okay. Very good. Very good. Excellent. Questions there? Is everybody good? Okay. So number 5 then. We got Grateful 8 company is expected to maintain a constant 3.7 growth rate on its stock. Okay. If the company has a dividend yield of 5.6, so dividend yield 5.6%. They want to know what's the total return.
9.30%.
Yeah, we just got to take those and add them up, right? So you get 0.0. What was it? 9, Madison? 9.
30.
30. Thank you. I thought I heard 37. I just wanted to make sure I was getting that right. Thank you. Okay, 9.3%. Hopefully no questions on that one. You just had to add them together, right? Okay. Let's look at number 6 then. Suppose we know the company's stock currently sells for $74. So PO, current price, $74. The required return on the stock is 10.6%. Okay. You also know the total return on the stock is evenly divided between the capital gains yield and the dividend yield. Okay. So what does that mean? Why do they give us that information?
That means they equal each other.
One more time, Carolyn.
It means they equal each other.
They equal each other, right? So that means that, and basically that's telling you what G is, what your growth rate is. And the growth rate then is what?
2.6.
5.3%. Half of the total return, right? Because the total return is your dividend yield plus your capital gains yield. It says it's equally divided, okay? All right, if the company's policy to always maintain a constant growth rate in the dividend, what is the current dividend? So what are they asking you to solve for here?
D1.
D0.
One?
Is it? Oh, is it D? Oh, I guess it would be D0.
They want you to solve
D1.
for D. Yeah, they want you to solve for D0, but you need to get D1.
Exactly. So the first thing we're going to solve for when we put all this in, right, is we end up solving for D1. Okay. So let's see. So if we do that, right, we got PO equals D1 over R minus G. So we have 30, oops, sorry. So we have 74 equals D1 over 0.106 minus 0.053, right? So you get D1 equals what?
3.92.
Okay, 3.92. But you guys just told me that is not what we're looking for. So what do we need to do now?
Find D0.
Okay, and how do we go about doing that, Madison?
You set D1 equal to D0 times the growth rate plus the rate.
There you go. So, and then we just fill it in, right? 3.92 equals D0 times 1.053. Okay. So then D0 so then D0 equals what?
3.72.
Okay. Very good. Okay. Is everybody good with that?
Mm-hmm.
Okay. Now, folks, the one thing I want you to pay attention to is make sure, okay, just like Colin was when we asked, oh, we're looking for D1. Make sure you read the problem to follow it to its conclusion. We were looking for D0. And you guys know how I feel about you. I don't want to hurt your feelings. So I would have 392 and 372 on there for you. That way you get something that's on the paper, right?
Cool.
What's that look, Ben? All right. Everybody good? Okay, let's move on. Okay. So where are we at? Problem 7, okay? You got Burnett Corporation pays a constant $8.25 dividend on its stock, okay? The company will maintain the dividend for the next 13 years and will then cease paying dividends forever. The required return is 11.2. what's the current sale price of the stock? So how did you guys go about this?
I use the calculator.
I use a calculator.
Okay. Yes, I'm glad we use the you use the calculator in what way though?
Using
I
the
plug-
net present value.
One more time, Carolyn.
I use the net present value.
Net present value. Okay. Somebody up, was that you, Madison, that was saying something too?
Yeah, I did 825 for the payment, 11.2 for the rate, 13 for N, and found payment.
Okay. So, and Carolyn, I think that's what you were driving at too when you said net present value, correct? Is that how you did it also? Because what?
No, I use the net present value key here
Yeah.
and the CF key.
Okay. That's what we're going to get into in the next chapter.
Okay.
Kind of the shortcut I said I was kind of holding for you guys because I wanted to make sure you understood you need to close your curtain there, Carolyn.
Yeah, I know.
Um, So, but what are we dealing with in this problem? What is this problem? It's something we've already dealt with. Madison, what is this problem as?
What?
Oh, this is
What did you see? Go ahead, Colin. I think you meant, did it just come to you? What is it?
this is zero growth.
Yeah, is it constant dividend growth?
It's a constant growth, zero growth model.
So is it basically an annuity?
Oh, yes, it's zero growth, but what's the difference between what we did with zero growth and this problem?
It doesn't go on forever.
Exactly. With what we did, what we were talking about yesterday or Tuesday in the lecture was with the zero growth, just like Carolyn said, that would go on forever, making it a perpetuity, right? This one doesn't go on forever, so what does it make it?
An annuity?
It's an annuity. Very good. Okay. So think about it. We got 13 years, right? And we have these 13 payments of 825. Okay. And our growth rate was, or our return on the stock, I'm sorry, was 11.2%, right? So when we look at this, so we have our interest rate, we have N, and we have our payment. So we know this is an annuity. So we just solve for the present value of that stock. Okay. Like I said the other day, guys, don't dump out your toolbox just because we're in chapter 8, and forget everything else that you've learned. So what do you get for the price of this stock when you do that?
55, 13.
Yeah. There you go. Okay, is everybody good with that? Okay, any questions? Okay. All right, so everybody got that? Everybody realized that, I hope. All right, let's move on. What was next? 8, problem 8, okay? Preferred stock. Now we're getting into the constant payment, zero growth, perpetuity type thing. Okay, so we got Bedecker Inc. has an issue of preferred stock outstanding that pays $3.40 a $3.40 dividend for every year in perpetuity. The issue currently sells for 91, and they want to know the rate of return. Well, we know that our price equals the dividend over our rate of return, right? So we have our price at 91. Our dividend is 340, and we're solving for R. So what does R equal here? What's our rate of return on this preferred stock?
3.74%.
There we go. Everybody good there? Madison, what's for breakfast this morning?
Pineapple.
Yeah, well, there you go. Pineapple. I love pineapple. All right. What do we do next? 9? Yeah, jumped on 9. Okay.
Really?
So 9. Oh, I like this one. This is a good one. All right, so we got red, yellow, blue. Each will pay a dividend of $3.65 next year. The growth rate on the stock for all of them is 4%. The required rate of return is 8, 11, and 14. What's the stock price? Okay. So we know next year D1 is the dividend. It's going to be $3.65, right? And we know all of them have a growth rate of 4%. Okay. Now, we're going to have red. And I know they have yellow, but I'm going to do it in green because you can't see green or the yellow on the, whoops, let me move that down here. And blue, right? Now, we're looking for the price of the stock, okay? So the price for red, we're looking for the price. We got $3.65, okay? The rate of the required return on red is 8% with a 4% growth rate. So what's the price of the red stock here?
91.25.
Okay. All right, and then when we get to the next one, we got a price of $3.65, but their return is 11%. Is it 11? Did I jump too high? Yeah, 11% with the 4% growth rate. And what's the price of the yellow stock?
52.14.
And then we go to blue with a 14% return, okay? And what's the price of the blue stock?
52.14.
Now that's the yellow one, Dave. The next one.
Sorry.
36.50.
Yes. Okay. Very good. Did everybody get those numbers? Everybody good? Okay. Now then, so it asks, what do you conclude about the relationship between required return and the price of the stock?
As rate of return increases, stock prices decrease.
Okay. And what causes that, Madison?
It gets farther away from the growth rate.
Okay. Yes. And what else?
More risk, less or lower price.
The greater the risk, we want a lower price. Exactly. Okay. What else? I like the way you guys are thinking. Keep going. What you're seeing here, basically, folks, is we showed this graph on the PowerPoints the other day, right? But what we're seeing is the effects of time value money on stock price. Okay, all things equal, the greater the return, right? The greater the interest rate, the smaller the present value. And that's what you're seeing here. Okay, does that make sense? Everybody good? Okay. Any questions before we move on? All right. Let's see. Let's look at 12. Okay. Now 12, I gave you this for homework, but quite honestly, I'm not going to have this isn't going to be on the exam. Okay. So what we have here, we have stock valuation and PE ratio. So you got the perfect rows as an EPS of 318. So we have an earnings per share of $3.18. Okay. The PE benchmark is 18. okay? And they want to know what stock price would you consider appropriate, right? So really what we have to do here is take the 18 times $3, take the 18 benchmark times the 318 earnings per share, okay? And you get 57.24, okay? Does everybody see that? Everybody good with that? So when we were talking about the and then they mentioned, what is it? What if it was 21? Okay. Okay. So we talked about what if they didn't have a dividend? How would we calculate the stock price? This is an example of that. Okay. You use the earnings per share times the benchmark, and that would get you your stock price. Okay. Everybody good there? Okay. Let's go on to what was next, 15? Problem 15, okay? So here we have non-constant growth. Okay, you got Metallica Bearings, young startup company. No dividends will be paid on the stock over the next 9 years because the firm's going to plow that earnings back to fuel growth. The company will pay a dividend of $17 a share in year 10 and will increase the dividend 3.9% thereafter. The required return on the stock is 12%, so they want to know current price. So tell me, how did you guys go about doing this one? How many attempted this one? A couple of you? Okay.
Well, what I did is I calculated the price at year 9, and then I went backwards using time value of money.
Exactly. So let's you guys know I like my timeline, so let's put this on a timeline, right? So Carolyn, what happens those first 9 years?
Nothing.
Nothing, right? But what happens after that?
We start getting dividends.
Yeah, so in year 10, right, we're going to get a $17 dividend. And then what do we know about the dividends every year after that? They're going to grow. Yeah, very going to grow at 3.9%, right? So with that information, what can we calculate? Carolyn, what did you say you calculated?
197.67.
We could calculate the price in year 9, right? And that's what you did, right? So remember, P9, for P9, we need dividend for the year 10, and then we just have R minus G, right? So we have all that, so we can calculate the price in year 9. Dividend 7. Oops, I didn't put in the 12.5% is our required rate of return there, right? So we have 12.5 minus my 0.039. So 17 divided by, what is that? 8.6?
Mm-hmm.
Is that right? Yeah, 0.86. Okay. So, Carolyn, what was your price there in year 9?
197.67.
Okay. And then what do we do with it?
Go back to P0.
Exactly, Madison. Now we got to do what we've done in chapters 5 and 6 and all that, and we got to discount that back to P0 today. So there's my interest rate, there's my N, there's my future value. And what do we get for that price?
68.48.
Exactly. Okay. Everybody good?
Mm-hmm.
Questions on that one? Okay. All right, let's move on then. So let's see. What's next? 16. So you've got this Mauer company has an odd dividend policy. The company has
Wait, what question is this?
what?
What question is this?
Did I not give you 6?
Mm-mm.
No? Okay. Which one was next? I'm sorry.
15 was the
There's a-
last one.
What? 15 was the last one? Okay. All right. I thought I gave you a couple more on that. Okay. So any questions on anything that we've done so far? Nothing? Everybody's good?
What was the answer for the present value on the last one? I didn't hear it.
68 right here, Colin, I'm sorry. Right there, 68.48. Were you with us when we solved for the price right there, the 197.67?
Yeah, I was there, but then I went back and did it, and I'm not getting the right answer. I guess I'm doing.
Okay. When you're checking that, Colin, what's one of the first things you need to check?
I got it now. I cleared it. I reset my calculator because it's been giving me different numbers all day, so I reset it real quick, and I'm getting the right answer now.
All right, sounds good. Okay, so any questions on anything out of the rest of the chapter? Chapter 8. Is everybody good? Okay. Let's talk about the exam a little bit then. Okay. Let me see here. So your exam, it's going to be on the McGraw-Hill site. Okay. And let's see here. 43 questions. Okay. So you got 43 questions. 1, 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So there's 14 problems, and the rest are going to be concept, multiple choice type questions. Okay? So 14 problems and about 30 concept type questions. And again, remember, those are pretty much, let's see, evenly divided. So you have 1, 2, 3, 4, 5, 6, 7. You got 8 problems out of chapter 7 and about 6 problems out of chapter 8. Okay?
Okay, say that one more time. I didn't hear it.
8 problems out of chapter 7 and 6 problems out of chapter 8. Remember, the exam is just on chapter 7 and 8. Okay? So let's go, before we go back to chapter 7 and talk about it for a minute, remember there's those extra problems on As You Learn. If you need those, make sure you work those out. You can shoot me emails, ask me questions on those. and we can go from there. I think I put some extra problems on As You Learn for you from another book, if I remember right. And those have the solutions with them. Okay.
Are you still giving us?
Is that a question?
Yeah. Are you still giving us an hour 15?
Yes, ma'am. Yes. Oh, and I'm glad you asked that, Madison, while I'm thinking about that. So if anybody has the ODS or extra requirements, again, shoot me an email and remind me of the parameters of that so I can get that set up when I put the exam on the site, and I can get you taken care of with that.
Do we still have all day to take it?
What was that, Kyle?
Do we still have all day to take it? Like,
Yeah,
started
yeah.
with
I'm gonna set it up that way again.
okay. And is it going to be an As You Learn?
No, it's gonna be on the McGraw-Hill site.
Oh, I thought you said it wasn't. Sorry, misheard you.
Yeah. No, it will be on the McGraw-Hill site.
Okay.
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 And everybody seemed to have an okay time getting on there. There didn't seem to be any issues with that, at least getting on it and taking it. Okay. All right, so let's talk about chapter 7 a little bit. And folks, if you have questions, you need to, chime in, make sure your questions are getting answered. Okay. If you remember, we started off with bonds. We were talking about the features of bonds, bond prices. Remember also in chapter 7, it is very heavy in vocabulary, and I didn't read all the vocabulary to you guys and things like that. So you need to make sure you have read the vocabulary and that you're up on the vocabulary. Okay. So we talked about bond values and yields. Remember, we did those 5 different examples in our notes with the bonds. Okay. Semi-annual bonds. Okay. Talked about interest rate risk. If you need a reference, that was figure 7.2 for that. We did a few examples of that. We talked about whether bonds were debt or equity, why we would use bonds. Okay. What was the indenture again? Anybody remember?
What was the what?
The indenture. Indenture. Remember, that was the contract with all the details of the bond, when it matured, if it was call, was it a callable bond, what the call provisions were, things like that. Okay. We talked about premium bonds and discount bonds. We talked about the bond ratings, and we looked at the figure on page 211 for bond ratings when we talked about those. We talked about the different types of bonds: government bonds, zero coupon bonds, floating rate bonds, municipal bonds, T-bills. Okay. We talked about the bond markets and bond prices and reportings. We looked at the figure 7.3 on page 221. And then we looked at figure 7.4 on page 222, talking about the treasury bonds. Okay. And then if you remember, we finished the chapter talking about inflation rates, real rate versus nominal rate, and how inflation affected that. So the Fisher effect, and we had that equation with the Fisher effect. Okay. We ended up, the last thing we talked about was determinants of bond yields. We mentioned the 6 different determinants of bond yields. We also spent some time on the figure 7.5 on page 227. That was the interest rates from 1800 to 2015 or something like that. And then figure 7.6, where we had the term structure of interest rates. We had the upward sloping yield curve and the downward sloping yield curve. Okay. Is everybody good on that, or does anybody need any questions on any of that? Okay, everybody good? All right. So then we went into chapter 8, common stock. You know, we talked about stock, why we issue stock, the cash flows. We talked about the 3 different types: zero growth dividends, constant growth dividends, and then the supernatural growth dividends. Okay. What else? We talked about the components of the required return, the dividend yield and the capital gains yield. Okay. We looked at the table 8.1 on page 250. And then we got into some features of common stock, proxy voting, voting rights, the rights when it came to dividends. Talked about preferred stock, stock markets, talked about the difference between dealers and brokers. Okay. The license holders, 1,366 license holders are members of the stock market. Okay. We mentioned the NASDAQ, you know, briefly, just kind of what it was and how it came about. Okay. Is everybody good there? Any questions on anything? Okay. All right. Now then, let's look at, hang on a second here.